Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. It's not often you get to say it's a Friday coming out of a holiday, but the mood is a bit gloomy when it comes to the large caps. They've taken a step back. The Nifty is hovering below 22,700. It's a good 100-point cut on the Nifty. Sensex down 350 points, but mid-caps is still going strong. The mid-cap index is a gain of about 0.3%. And with that, today, mid-cap index is back to its record high levels. And this week, it's seen a gain of about 1%. So that's where the action is.
Absolutely. I think we're just kind of, taking a step back after what's been a very good rally. We had all-time highs this week itself on the market. So maybe just some consolidation, just sort of taking a pause and breathing it all in. In terms of the large cap screen, trends are hard to define. One clear trend is that that correction and that cool-off is visible in banks, because if you look at the bank Nifty, that's actually leading the declines in a way. It's down about 0.6%. So quite a few of the bank stocks are weaker. But then, sort of it gets muddled from there on. What are the other parts of the market that are down? Some consumer names, for instance, Titan. Titan could also be an impact, a fallout of these soaring gold prices. Typically, the question is, how much will demand get hit by, because you are talking such elevated prices on gold? So there's some correction that's taking place on Titan. HUL and ITC are the other consumer names which are slightly soft as we speak. Now, even in banks, it's actually HDFC Bank that's falling the most, down about 1.5% to about 2%. But then on the other, on the upside, you have TCS. All eyes on this one. Reema will very soon tell us about what's in store. The earnings season officially really kicks off with TCS today. And then there is NTPC. So the good news is coming in the form of the possibility of finally that renewables IPO, the renewable assets business of NTPC, which the market seems to be getting excited on. In fact, since we're talking about NTPC, let's straight away kick it off with this one. Lots of stocks in focus. This is one of them. We have Vivek joining in with the details on what possibly is going to be a pretty large IPO from the NTPC stable, all about going green. Vivek.
NTPC, this has been one particular trigger that the market has been waiting for very keenly, like you rightly mentioned. So Money Control reports that NTPC Green Energy, which is the subsidiary of the company, this particular subsidiary houses all of the renewable energy assets of NTPC, as the name suggests. So now they've gone ahead and shortlisted investment bankers. They expect the size of this particular IPO to be quite large, almost 10,000 crores is what they're anticipating. They've appointed IDBI Capital, IIFL Securities, Nuvama Wealth, as well as HDFC Bank as the bankers to this particular IPO. What is the company going to use the proceeds of this particular IPO for? Mainly for capex. So number one, ongoing as well as future solar energy plans. Number two, green hydrogen. And number three, green ammonia forays that the company is planning. Now, just to give some perspective, as you know, the size of NTPC Green Energy business, total business, it has a capacity of close to 74 gigawatt, out of which renewable currently is quite small at 3.4 gigawatt. However, remember one thing, the company has significant plans to go ahead and ramp up its renewable energy foray. So, number one, FY26 guidance is to reach almost 15 gigawatt of renewable energy storage. So, when you're talking about, the kind of dilution that I expected, analysts expect somewhere to the tune of 20 to 21%. Again, so this will value the arm quite significantly higher, and which is why NTPC is in focus today.
Okay, thank you very much for that. A small company called Crystal Integrated Services is up close to about 10%. Now, this is a company which provides facilities management. It's a small company. It's a recent IPO. It provides facilities management, which basically means if you have a large corporate house or a manufacturing facility, it will provide sanitation, plumbing, all the electric services that you need. It also provides security and staffing and also security services, providing private guards to ensure its protection. Now, we had a chat with the management earlier today on Crystal Integrated Services. And the company said that they're quite confident that they will be able to grow at 30% for the next 3 years, and margins will remain around these levels. So that's gotten the stock quite excited. As I said, it's a recent listed. It listed on the 21st of March. The issue price was 715, and the stock, was at 850 yesterday, and today it's moved up. So if you could just get that stock for you, Crystal Integrated Services, which is locked in an upper circuit of close to about 10%. Other than that, you've got Zomato once again trying to make a dash towards the 200 rupee mark, 199.25. Today, there is a report which has come in from JM Financial where they say that Zomato's quick commerce business will exceed the size of its food delivery business much earlier than what they had built in. It will ensure that Blinkit builds long-term scale moats against continued threats from growing competition. And JM Financial has raised the target price on Zomato to 260 versus 200 rupees earlier, following the meteoric rise of Blinkit, and that will continue to be the big driver. But moving on now to Pharma and Sun Pharma, which is the top Nifty loser. US FDA's classification on its inspection of the company's Dadra unit. Ekta is here with the details. Ekta.
Thanks for that. Well, yes, USFDA conducted an inspection for the company's Dadra unit, Sun Pharma's Dadra unit, from December 4th to the 15th. They have classified it as official action indicated status now based on that particular inspection, which had received 6 observations in December of 2023. Now, OAI basically implies that a regulatory action is recommended. So that means that if in case Sun Pharma does not really solve these observations as per the recommendations or the requirements of the USFDA, then there is a higher probability that it could probably escalate to a, something worse, such as a warning letter or an import alert. Now, Sun Pharma has said that the company will work with the regulator to achieve fully compliant status. So let's see how things progress. But as of now, definitely a negative for Sun, considering that their one unit has been classified as OAI.
Okay, got it. So that is Sun Pharma at the crosshairs with the US FDA today. Ekta, also let's talk about a bunch of other stocks that are reacting very well, actually. Syngene is one, Newland is the other one. And the reason these stocks are so excited today is because Goldman Sachs has initiated coverage on the entire pharma space, specifically when it comes to contracted research and drug development. So Ekta, fill us in. Tell us more about what GS is saying, and specifically why do they like these stocks?
Well, Goldman Sachs has initiated a buy on Syngene, target price of 875, initiated a buy on Newland with a target price of 9,100, and initiated a sell on Laurus Labs with a target price of 350. So the general larger overarching theme, according to Goldman Sachs, on the CRO CDMO space is pharma R&D outsourcing target addressable market is around 200 billion, which is seeing double-digit growth. They forecast India's global market share to increase by 30 basis points in the small molecule CDMO space and 70 basis points in the contract research space by FY28. This is their base case. Now, share gains could be threefold according to them in a bull case scenario where China +1 trends accelerate at a faster pace. Now, for Syngene, they have initiated a buy. They say that barring short-term macro challenges in CY24, they see multiple catalysts. This includes improving biotech funding environment, which was a challenge for Syngene. Separately, for Newland, they say barring challenges to FY25 growth on account of a high base, they see multiple catalysts in the form of commercialization of a large molecule in FY26-27. Besides that, any progress on the US Biosecure Act could bring in disproportionate benefits to the company, which means that there will be a shift in terms of business from China to other alternate markets. And when it comes to pharmaceuticals, it would be India. And lastly, on Laurus Labs, they believe that the risk reward is unfavorable due to lack of catalyst for the CDMO business in CY24. And the stock is trading at around 34 times FY26 PE, which is 2 standard deviations above its historical averages.
Okay, thank you very much for that. Moving on now to some brokerage calls. Credit Access Grameen and Entero Health are 2 stocks buzzing on the back of brokerage calls. Entero Health, in fact, is locked in an upper circuit of 20%. Sudarshan joins in to tell us what brokerages are saying about these stocks. Sudarshan.
So both these stocks are sharply higher after brokerage notes. So first I'll talk about GS on Credit Access Grameen. GS has initiated coverage with a buy rating and target is 1788 per share, which implies upside of nearly 30% from current levels. GS says company has demonstrated a good track record through the cycles and it expects a healthy 21% profit CAGR over FY24-26. As per GS, key catalysts are company has a diversified loan book, it continues to gain market share, and it has competitive edge on industry-leading credit costs and operating efficiency. Next is Jefferies on Entero Health. It has initiated coverage with a buy rating and target is 1510 per share, implying upside of 25% from the current levels, and stock is currently locked at 20% upper circuit. Jefferies believes it's a fast-growing healthcare products distributor operating in large and fragmented market, and it should see 20% organic revenue CAGR over FY 24-26, and estimate 8 times increase in adjusted profit as economies of scale kick in. In addition to that, it should benefit from industry consolidation as well.
Okay, that is Entero Health, and that stock is really zooming higher. Thanks very much, Darshan, for the details on that note that came in. 20% circuit and still, locked in that band. Well, let's move on now. Earnings season, as we said, is kicking off, and it's going to be all eyes on TCS today. Rima, the good thing is numbers are after market hours. Yes. Plenty of time for the street to digest the numbers, the commentary and all of that. But you tell us, what are the expectations?
Well, first, I just want to put on board that this time it's expected that TCS numbers come in between 3:30 and 4.
Okay.
Typically, it comes in closer to 4:30, but this time it's going to come immediately post-market hours is what we understand. So, guys, stay tuned in to CNBC-TV18 for, the analysis there. Press conference will be at 5:30. As is always. In terms of numbers, dollar revenue growth is seen up 1.6%. Constant currency revenue growth will be up 1.3%. This is a quarter where we're not going to see largely a big improvement in the numbers, which means the numbers are going to be similar to what we have seen for the industry per se to the December quarter. There is no improvement. For TCS in particular, the numbers are likely to be ahead of peers because for names like an Infosys, Wipro, Tech Mahindra, we're actually expecting revenues to decline. The reason why TCS's numbers could look up and better than peers is because one, ramp up of the BSNL deal, that ramp up contributed to even their prior quarter numbers, and two, the hope is that BFSI is going to pick up or at least bottom out, show some green shoots. Margins for the company are likely to expand by 30 basis points to 25.3%, which compares with 25%. And one of the reasons is the company is cutting back on its headcount. In 3 out of the last 5 quarters, the headcount for the company has come down, and maybe that's the reason why margins could expand. Profit number on an adjusted basis, because in the prior quarter, there was a provision for the Epic case. Profits are likely to be up 3%. What's the street going to track? Deal wins and pipeline. This quarter, deal wins are going to be strong for TCS, expected because of the large Aviva deal that they signed. So Kotak estimates the number for deal wins could be in excess of $10 billion. Recovery in discretionary spending. If you remember, Accenture spoke about further cutting back of discretionary spend starting January. That spooked the street. So recovery in discretionary spending, recovery in headwinded sectors, pockets which were weak, like North America, BFSI, communication, high-tech, retail. Are you seeing strength, some sort of a recovery in these? And finally, on headcount. Does the headcount continue to moderate? In the last 5 quarters, headcount for the company has declined by almost 13,000 employees over the last 5 quarters. Is headcount going to come down, or if they are seeing demand pick up, will the company start hiring? So these are some numbers and qualitative comments that the street will watch from TCS this time. Well, with that, we're going to slip into a break. On the other side, we'll discuss commodities. Manisha Gupta joins in. Stay tuned. Welcome back. The Nifty is still down close to about 95 points. One, there is some cautiousness, perhaps some anticipation ahead of the Q4 earnings season, which begins today. And two, even the global backdrop. US markets were subdued yesterday following the stronger than expected CPI inflation print. So those could be 2 reasons why you've seen large caps take a bit of a backseat today. The Nifty down 95 points, Sensex down 350 points. Global markets have been subdued. And plus, maybe a wait-and-watch approach ahead of the earnings season, which starts with TCS today. But Manisha is now with us for a check on the commodities. Manisha, what do you have?
Well, thank you for that. I'm looking at aluminum prices, which are trading at around 14-month highs right now. When you look at the last 1 month or 4 weeks, aluminum prices have gained up by nearly 10%. The support comes in from the fact that the March manufacturing data in China has been on the positive side. The PMI data does show that numbers in US and Germany also have been on positive. Also, an upgrade coming in from China has been supportive for metals across board, especially when it comes to aluminum. There still are supply concerns coming in from from Guinea. That is where we've seen a fire explosion in a facility, so the supplies have been disrupted. On the other side, when you look at Yunnan in China, there are concerns about production and refining here as well because of the drought kind of situations that province is facing, and that is adding premium to prices. And as I said, it really is a rally across board on metals. So while you have aluminum prices trading at a 14-month highs, you also have copper, which is trading at a 15-month highs. Zinc is trading at a 12-month highs as well. So there is a lot of support that we are seeing coming in for all of these metals.
All right, Manisha, thank you so much. So it's still up and away on the metals landscape. Thank you very much for that. By the way, Rima, I just remembered that on Markets Forward on Wednesday, Shrikant Chauhan was, talking us on technicals, and he actually gave a call. We were asking him, saying all the metal stocks have gone up, so what to look at next? And he mentioned that the aluminum chart is looking particularly strong. Okay. And then I remember, I think Nalco was one of the equity sort of plays that he was talking about. So yeah, they're going to make a note of going back and telling Shrikant about this. But that's commodities for you. Really making the headlines all over again. We'll take a break on that note, come back on the other side. We'll discuss market technicals. We'll have Mitesh Thakkar join in, get some trading ideas going. Welcome back. You're with us on Trading Hour, and let's take a look at some more stocks that are in focus. A couple of telecom names actually making it to the headlines today. The first one is Vodafone Idea. Now, Vodafone Idea is doing a large FPO, a follow-on public offer. Rima, tell us the details, the size, quantum, floor price, all of it.
Well, it's a follow-on public offering. Aggregating up to 18,000 crore rupees, and it begins on the 18th of April. And finally, the price. The floor price has been set at 10 rupees with a cap of 11 rupees. So a fair amount of discount to where the stock currently is. Now, why is the stock under pressure? One, because the floor price is set at a discount to the current market price and by a significant bit. Two, it was expected, right? The minute the promoter infusion happened, the street expected that, promoters are infusing money because they have the confidence that the external fundraise is going to happen. And three, it's a very large dilution. The market cap of Vodafone Idea is close to about 60,000 crore rupees, and they're raising 18,000 crore rupees. So there is going to be a fair amount of dilution. That said, it's still a positive for Vodafone Idea. One, remember that the floor price or even the cap at 11 rupees is at a discount to the price at which promoters are pumping in money. Promoters are putting in money. Why the preferential issue at 14 rupees 87 paise? When Aditya Birla Group committed that 2,075 crore, that price for the preferential issue is 14 rupees 87. So it's happening at a discount to what the promoter price is. And two, it will provide the company much needed capital. This has been long waited for more. I think about 2 years the company has been waiting. And finally it's happening. It will roll out their 5G position. So in that sense, it's a positive. The company in the meeting today also go on to say that the company will be participating in roadshows. They'll interact with investors and analysts starting 15th of April till the closing of the offer. But this is the much-awaited Vodafone Idea fundraise, follow-on public offering up to 18,000 crore rupees, which means coupled with the promoter infusion, the company, as promised, will be looking to raise 20,000 crores via the equity route. The floor price for the FPO has been set at 10 rupees, a discount to the current market price.
Okay, it's a big development for Vodafone Idea for that kind of money to finally come into the company and then equity, capital at that. So that explains Vodafone Idea being in focus today. The other one is the new kid on the block from the telecom sector, Bharti Hexacom. And should pull up the stock. It's still quoting at a gain of 47% to the issue price. So quite a bumper listing, Rima.
It's a bumper listing, and it's only getting stronger because the listing price was 755, a 32% premium, and the stock has gained after that. It had also seen strong subscription, close to about 30 times in terms of the overall size. Now, about this company, a quick word, since it's day one, not many of us would know what the company does. It's a telecom service provider company. It provides you mobile services, but it provides it in two circles, Rajasthan, Northeast. Rajasthan contributes 78% of its overall revenues. In Rajasthan, it's the number 2 player. In the Northeast circle, it's the number 1 player with a market share of more than 50%. Promoters hold 85% stake in the company, which is 70% Bharti Airtel. 15% is a government-owned entity called Telecommunications Consultants India. The financials, 6,500 crore plus of revenues last year. margins of the company have been on an increasing trajectory, and that's been driven by the ARPUs. ARPUs for the company were at 135 rupees in FY21. It's risen to 197 in 9 months FY24. JM Financial has initiated coverage, target price set at 790. They believe this is an ARPU compounding story. If you want a mid-cap play, which is a pure play on India's wireless story, on India's ARPU increase, tariff increases, the premiumization, then Bharti Hexacom is your play. Because there is a Bharti Airtel, but Bharti Airtel also derives revenues from other businesses, the Africa business. It derives revenues from the enterprise business. So if you want a pure mobile services play and you want to ride the fact that India's tariffs are cheaper than the world, they will go up, subscribers will upgrade from 2G to 4G, then they believe Bharti Hexacom is the play. They also go on to say Rajasthan and Northeast are high growth potential markets because the tele density, the number of people owning a phone are on the lower side, and plus they have fewer higher ARPU subscribers. So they're penciling in ARPUs to go up. They expect margins to go up. Currently, margins are at almost 50%. They think it can go up to 57% by FY30. So that's the JM Financial view on Bharti Hexacom. We will slip into a short break on that note. On the other side, we'll discuss market fundamentals. Manish Dangi of Macro Mosaic Investing and Research joins us.
Welcome back. So the consolidation continues this Friday on the street. We have Mitesh Thakkar joining in as promised with some trading calls and ideas. A bit of a uplift on the Nifty that the bulls are trying. Mitesh, hi. Good, happy Friday and good Friday to you. So just tell us what the trading bets are like now.
So I think, while the markets have been weak, Survi, good morning. The overall breadth is very impressive and a lot of stocks are showing good traction. So I would recommend a buy on PFC with a stop at 403. Look for a target of around 422. And BHEL is a buy with a stop at 262 for targets of 275.
Okay, BHEL and PFC. Just checking the Bank Nifty once, Mitesh, because it's finally seeing some consolidation after a pretty good rally. What are the important levels here that you're tracking? And on HDFC Bank as well.
Yeah. So Survi, one, HDFC Bank is looking good. It's coming out of an underperformance mode, so it should be doing better in the next few days. And on the Bank Nifty, I'm looking at 48,550 spot, which is roughly about 150 points lower from here as the first support area. If that breaks, then I think we'll lighten up on banks. But as of now, we're holding on to long positions.
Okay, thank you very much for that. Let's turn our attention now to the macros. Manish Dangi, founder of Macro Mosaic Investing and Research, is with us on the show now. Manish, morning. First call on the US now. Given the strong blowout jobs data and now the stronger than expected inflation number, the rise in the US 10-year bond yields to levels of 4.5% plus, what's the US macro setup looking like according to you, and what should we expect in the next 12 months?
So US data has been a bit of a disappointment for any good macro cyclical trader. It's been a basket case. The country economy hasn't disinflated in last 2-3 months. There's been a significant disappointment on the inflation side. Growth has sort of steadied at long-run average of about 2%. So now it's so divergent from what is happening in the rest of the world. Even adjacent countries like Canada, most OECD countries have had decent disinflation. The growth has actually has declined. The forecast has declined over the last 6-8 months. So in some sense, US is turning out to be a sort of a basket case for such a large country to behave so differently. And as you said, the job data has been very, very strong. 4-5 months ago, sort of it appeared, given job losses, that a SAM rule would kick in and, by June, July, US would enter in significant slowdown, if not recession. But, a lot of those calls have been pushed away. So if you're a pure cyclical trader, it's likely that such high real rates eventually would begin to hurt economy. But if you're a data watcher, then yet there is nothing significant to suggest that US is slowing in a meaningful fashion.
Manish, hi, good morning. Great to have you on the show, which is why I ask you, this entire narrative around, and even the Feds fueled the narrative, right? Why put it on anyone else, saying that 3 rate cuts are very much on the table for this year, etc., etc. And this narrative is happening at a time, and just look at real prices around you. I mean, cocoa, crude, coffee, gold, I mean, anything and everything, metals. I mean, all of these commodities are shooting higher and higher, multi-year highs for many of them. So, against this backdrop, and then we had the consumer inflation numbers in the US, right? And they were hotter than expected. So somewhere are the equity markets going a little off the charts in terms of reading the reality, and maybe the bond market, I mean, the US 10-year at 4.5% is calling it more accurately.
So a couple of things. One, of course, is what is more paradoxical is that metals, crudes, everyone is rising, even when actually dollar is strengthening. Gold is rising and dollar is strengthening. Real rates are like super elevated. So in some sense, it's a macro that you haven't seen for a very, very long time. As far as equities and bonds are concerned, sort of they're pointing at something similar, which is like no landing scenario. Equities sort of are suggesting that while there's going to be some slowdown, but there are not going to be significant cuts. The fact that in the last few days, bonds have actually sold off more than equities sort of tells you that in general, the view is that, they're going to be some pinching because of higher yields, but it's not going to hurt the economy enough for to have sort of a significant earning recession, so to say. So in some sense, both equities and bonds have actually converged. They're not as divergent as they were, throughout 2022 or even 23.
Okay, so now let's bring this back home to India and where we stand against the larger global context that you just described. Because the last policy was absolute status quo. Then there's this expectation that because of our global bond index inclusions, we'll have so much money coming in that yields should remain pretty benign here. At least that's the last narrative that I heard. Do you subscribe to that? And again, how does this sort of hold against the backdrop of slightly higher elevated US yields, elevated inflation, etc.?
So for Indian yields, so for Indonesian, so for Chinese, the only sort of worry is, and it is a significant worry of the trifecta of higher dollar, higher USD, and higher crude. As I said, it's a bit of a 2022 sort of a global macro setup, at least the US macro setup, so to say. But then Asia, across Asia, I mean, China is actually at cyclical lows in terms of yield. In 5 years, of course, now the COVID effect has faded. Chinese rates are about 150 basis point lower. Indonesian rates are about 150 basis point lower, when the US is actually 250 basis point higher. India rates are flat. India hasn't had a significant cyclical slowdown in terms of growth so far. Last 2 months have been decent, but Indian inflation actually has been adjacent to what Asia has seen. And so to some extent, you have sort of all levers in place which will drive sort of bond yields lower over the next 1 to 2 years. Okay, to summarize, if you're a bond trader, then you have to have strict stop losses, because in the wake of $90 of crude and $105 of DXY and 4.5 of USD, you really can't put on a very large position long bonds, so you have to be very, very careful. But if you're an investor, then these are sort of very attractive yields, and very likely that in next 1 to 2 years, my view remains that we will sort of have a significant both disinflation as well as lower yields. And that would mean that there will be a return parity in equities and bonds. So from an investor point of view who doesn't sort of bother much about, a few weeks and months of sort of obstacles, there is a decent case to make that it's a long bond trade.
How are the macros looking, Manish, of the other emerging markets? Do you look at it carefully?
So basically, again, what matters more is to us, at least, is Asia, and what has happened post COVID. So it's as I said, it's interesting to compare what was in 2019 pre-COVID and now, given that all COVID effects have faded in 2024. You've had very, very divergent outcome. In Asia, you have significantly lower inflation impulse than what we used to have, including in India. And so therefore, the bonds sort of impulse is to go lower and lower, and which wasn't the case in 2018-19, if you remember, a little bit of a perk up in crude, and we saw sort of bond yields shooting off everywhere, not just in India, but adjacent. So from an emerging market point of view, I think there is a lot of disinflation. The growth impulse is weak, and therefore it's sort of a primarily a yield play instead of a growth play.
Okay, all right, got that. We are in a conundrum. Macros are not what they usually are, but as you're saying, I haven't seen this in a while. Thank you very much for making sense of it all. Really appreciate you being with us on the show today. We will take a break. On that note, come back on the other side, and we'll put the spotlight on the defense sector. Nirmal Bang has come out with a very detailed report on the sector, the opportunities that the listed space is throwing up. So the authors of the report, Jyoti Gupta and former CMD of BEML, Deepak Hota, will join in for some perspective.
Welcome back. Tata Steel has started moving up. So pull up that, intraday of Tata Steel. The stock is up close to about 0.5%, but it's nudging higher bit by bit. Ultratech Cement is also another stock which has gotten back into the grain, but that also has an upward sloping chart. And M&M is the other one. The stock has just managed to get its head back in the grain. So that's where some of the action has been in the large cap space. But other than that, in terms of big movers, it's been about the autos. The Nifty Auto Index has been the best performing index. Tata Motors is up 1.8%. Eicher Motors, Bajaj Auto, these are stocks where you are seeing some gains. Eicher Motors, in fact, has an 8% rally this week. So it's been one of the stars. TCS is also seeing some buying. Ahead of its numbers. So TCS is a gain of about 0.5%, and Reliance Industries is managing to hold itself up in the grain. On the way down, it's Sun Pharma. We discussed that in greater detail with on its Dadra facility. Ekta joined in. HDFC Bank too has been lackluster. It's down 1% today, but this week in 4 trading sessions, HDFC Bank is down close to about 2%. So HDFC Bank has been a bit of an underperformer because while this week HDFC Bank is down 2%, Axis Bank is up close to about 2.75%. So it's underperformed that. Even Kotak Mahindra Bank is up 1.5% this week, and ICICI Bank is up nearly 2%. So HDFC Bank has lagged its peers.
Yeah, I mean, it kind of led the move when banks started. The prior week when banks started participating in the market rally, and now it's cooling off after that move began. Okay, let's take a look at some more stocks in terms of the price and volume action. Some of the PSU names on the metal side, they're seeing a bit of a cool off. Again, they've had a fantastic week. The last couple of days have been very strong. So today, stocks like Nalco, NMDC Steel, they're a bit on the back foot, down between 2 to 3%. So those are some of the names. On the upside, however, I mean, you still have a lot of PSUs that are going strong. So those are some of the ones that are falling. But look at SAIL. SAIL is charting its own course. It's also a PSU. It's also a metal stock. But SAIL is actually pretty much at the day's high right now. Very, very mixed trends coming through. That's SAIL for you. Doing quite well. Hindustan Copper is still holding on to a 1% up move. So even within the PSU metal universe, trends are really divergent. That is the short point. Well, on that note, we'll take a very quick break. Come back with that promised discussion on the defense sector with experts from Nirmal Bang. Welcome back. Let's get you some perspective on the market. We caught up with Tahir Badshah, CIO of Invesco Mutual Fund, to get his outlook on the current fundamentals. Listen into what he had to say.
I don't know about a lot of pressure, but I think there should be some pressure. There's quite a possibility because some of the macros have now started to once again unravel, and market will try to kind of once again get into that debate a little more aggressively with regard to whether it is interest rates or the geopolitical scenario and even our own political election-related outcomes, etc. So we're getting into the thick of that. There will be interruptions, punctuations, etc. along the way, driven by some of the macro indicators. But I think the larger and the more stronger focus will probably remain on how the earnings trajectory manifests itself. There have been expectations that there will be a slowdown as far as, or at least a deceleration in the momentum of new order flows, and probably some execution-related delays as well as we get into the thick of the elections. So I think that again is somewhere there in the mind of the market. We'll have to see as to what does it do to the shorter-term earnings growth over the next 1 or 2 quarters, or the top-line growth more importantly. I think the important thing also will be, like as I said, earnings delivery, and markets will look forward to some of those important stalwart segments like industrials, autos, oil and gas related companies, which are supposed to deliver strong earnings. Do they continue to deliver on that promise? Our value opportunities, perhaps a little more in the large cap IT names compared to the mid caps. And for some of our value strategies, we don't have a choice but to kind of, look at some of those a little more. And especially if we can, live with some of the softness that we are likely to see in the next quarter or so. But if we believe that during the course of FY25, the base will start becoming a little more attractive for them, things can start falling into place. We can probably, use the valuation support to be able to kind of buy into some of those names as well. But overall, at an aggregate level, I think it looks like from most assessments that IT budgets are likely to be flat for calendar year 24.
Okay, that's the market view on individual sectors. Now let's throw the spotlight on the defense sector. Now, Nirmal Bang in a note says, India's defense industry is likely to see an opportunity of $70 billion over the next 8 to 10 years. To discuss this, we're joined by Jyoti Gupta, research analyst at Nirmal Bang Institutional Equities, and Mr. Deepak Hota, ex-CMD of BEML. Thank you very much for joining in, Mr. Hota, and Jyoti for joining in. You've done some very in-depth analysis of the opportunity for the India defense sector, the evolution of the defense industry since independence. Can you quantify the defense opportunity for listed and even the PSU companies?
First of all, thank you so much for having me here and giving me this opportunity to actually discuss our report. This sector will see a major boom. What you currently see is, I believe, it's just over the surface of froth. The government is going to spend something like a 130 billion over the next 6 years by FY30. The space sector itself comes with an opportunity of 13 billion for the companies, whether PSU or private, into space sector. So, what we are doing currently are graduating from subcomponents to components, subsystems to systems. So we haven't actually reached to a level where we are even fully into subsystems, let alone the systems, a part of it. So obviously this 70 billion that you see is only for our companies in our coverage. But the opportunity is much bigger, and you should not look at defense in isolation to the civil infra. So obviously the opportunity is much larger than what is actually estimated.
Okay. Let me just take the discussion to Mr. Hota as well. So thanks very much for joining in. Really appreciate you being with us today. So just sort of tell us, what do you think is changing? One is the spends have been going higher. I mean, overall spends on defense. But also this whole move towards indigenization, and a lot of private names now coming up as well. Of course, HAL, BEML, BEL, these are all the public sector giants. But how do you view the recent trend of a lot of mid-sized private sector companies, component suppliers, subsystems, manufacturers? How do you describe the opportunity for the entire supply chain?
Well, good afternoon. Thank you so much for having me in this discussion. I would like to give all the credit to Jyoti for the massive research that she has done. But having said that, I look at the defense as a sector that is going to see much more boom. Now, why do I say that? It's when you look at the first, company set up in India and somewhere in 1700 by the Dutch, and the HAL was set up by Volchand Industries, a private sector. That was taken over by the Britishers, handed over to the Americans. And after that, we have seen a full circle of now the defense being triggered, I would say, by the national pride of the country. And this goes hand in hand with the economic progress of the economy, overall GDP going up. Now, the Make in India has been a fantastic success, I would say, but still we have a long way to go. The government has been very patient in evolving its policies. Now, I remember being there. This was during the COVID when the entire thing started, to create a level playing field. The public sector used to get certain nomination orders. Now, all that is, a thing of the past. You have inducted the private sector. You have given them a lot of, like, for example, exporting. You can export without having to wait for the that approvals, certain approvals which earlier used to be coming in the way. So what I'm trying to basically say is that India is going to go a long way. And given the global hotspots that we have, not only the tensions that we have along our border, but the various hotspots along the globe, all these are going to trigger the defense industry in a big way. The Make in India indigenization started off. We still have a long way to go. We should be very mindful of the fact that the foreign OEMs should not be still dumping the stuff and trying to show the labor as a percentage of the indigenization. So that's basically what I want to say. Thank you.
Okay. Mr. Hota, so while the opportunity is great, the order books are swelling for the companies across the board. The question is on the execution capabilities. Will the Indian companies be able to execute the large orders that they have on their hand and continue with that kind of a growth runway? Is there any risk to execution not matching up?
Execution is going to be something that we need to focus on. And this applies to both the public sector as well as the private sector companies. So because there's a lot of stuff happening in the country today, infrastructure build is happening along. So with that, defense also. And somewhere along the line, somebody feels a little peeved and some country decides to put an embargo on us. Now, these are all going to be things that we have to be mindful of. But execution, yes, I agree with you. We have to focus on it by investing more and more into the technology, more and more. See, manpower is also going to be a major concern for us because you don't get the right kind of people. A lot of people are retiring. Now, AI is also coming in. Industry 4.0 is also there. So these are all with a lot of technological changes happening. We need to be mindful of execution. Does that answer your question?
Yeah, Mr. Hota, yes, absolutely. And I think that's what the street also has its eye on. Earnings need to keep coming in while, of course, the order book growth is fantastic and the street understands that. Jyoti, let me take that question to you. In terms of getting sustained earnings momentum and then talking about the valuation question. That's the biggest one, right? Because stocks like HAL, when you see stocks go up 300%, as an investor, you're wondering if there's anything still left on the table.
Actually, this is not an industry. You shouldn't look at, there's no cyclicality. What you really need to understand is that they should have an order book. This takes time for execution. This is not a normal cement or any other industry which has an execution timeline. There is a lot of prototypes, there's a lot of testing, there's a lot of retrofitting, a lot of other aspects to this entire industry which happens, and therefore execution does take time because these are very, very sophisticated systems which is involved into it, and it involves national security. So I think what is important is look at the order book, look at the, it shouldn't dry up. That's the most important thing. While execution normally takes 14 to 24 months, and I think that is some people have to, the investors have to be patient for that.
What about valuations? That's the bigger question.
See, what you see the valuation, I believe it hasn't really come up. When we start working on core technologies, when you start looking at engines, propulsions, etc., UAVs, there's much more to come into these industries than what we are seeing right now.
I think you cover close to about 8 defense companies?
Yes, 8 companies.
And across the board, you have a buy or an accumulate rating. So you like it, the entire spectrum. I
love the entire spectrum. And when you spoke about the private companies, that's where, the private companies are going to act as support functions for these public sector companies, because there's going to be a huge demand for a lot of equipments across land, sea and air. There's a modernization scheme which is going around in Atmanirbhar, Make in India plan, and that's where a lot of ones, if you look at BL's order book, which is quite large, that's where companies like Astra Microwave Data Pattern comes in, because then they're into subcontracting and doing a lot of subcomponent parts.
So amongst these companies, which ones have the highest earnings growth? The valuation picture is on the screen, but talk about the earnings growth for these. Where is it that's the highest? And amongst the 8, would you have a preferred pick?
I would look at companies which are into their niche core technologies, which is HAL, which is right now you might be seeing it's not actually running, but it has huge potential. Then I look at BDL, which is another which is into launching systems now. Another is MDL, Mascon. Within private sector, I'm very positive on Astra, followed by Data Patterns. All these companies have, in fact, a lot of private companies which are doing a lot of work, which are into, making some very critical engines. They also have huge potential of growth for these companies as well.
All right, Jyoti and Mr. Hota, thank you very much for joining in and explaining sort of what lies ahead. It's a long trajectory. These are not businesses that you evaluate only for the next 1 year, but this is, a journey of decades. And I must add, Jyoti, I really love the cover of your report.
Yeah.
It's a beautiful. I don't know if the camera will capture it or not, but yeah, beautiful IF jets, in the sky with the colors
Let me
of
just hold it up,
Indian flag. I don't know if it'll capture, but yeah. If it can, we can see the jets. It's a
and
beautiful picture.
As you can see, it's a really in-depth report. How many pages?
I guess 156 pages.
156 pages.
All right.
Thank you for giving us that, summary of it, and thank you, Mr. Hota, for joining in. But we've got another important discussion on trading hour.
Yes, we do. So we do have to, I think, do we take a break or can we straight away move to that discussion? Okay, yeah, in fact, we can go to Pranav Saitha from EY now. Now, the discussion is all about this amendment to the India-Mauritius tax treaty that has taken place. This is the second amendment that's happening to this treaty. The first one was in 2016. Now, the latest amendment is talking about introducing what is known as the principal purpose test into the India-Mauritius treaty. So, does this change the way foreign investment is flowing into India from Mauritius? Well, let's ask Pranav Saitha, International Tax and Transaction Services Leader, EY India. Pranav, thank you so much for being with us. I think since yesterday, the tax circles have been abuzz about what the implications are and whether there will be retrospective applicability. What's your read-through once, you look at that little docket that has been put out?
Sure. So the way I read the language of this particular protocol, I do not think that the language suggests that it will have retrospective application. Having said that, I do recognize that the language is not very happy and it could at the ground level, at the tax office level, create a lot of confusion, lack of clarity and some litigation as well. So I would really urge that some clarification be issued to make it very clear that this will apply only to incomes earned, capital gains, for example, which gets crystallized or exit sale of shares that happens after the date of coming into effect or coming into force of this protocol. That clarification would go a long way in restoring confidence of international investors and bringing clear provisions in the protocol that it will not be affected retrospectively. I don't think that is the intention either of the government, to be fair, but I think a clarification is really something that one would wish for.
Fair enough. But, for an instance, if we read this protocol in the manner in which it's written, because it does say that, it will be applicable without effect to the date on which the taxes were levied or the years in which the taxes were levied. Could it be a material issue if the government at all decides to go back to transactions prior to 2017? And if it's not retrospective, then is it a non-event then in a way, this inclusion of the PPT?
Okay, you mentioned 2017, so let me clarify. There are two aspects of controversy or ambiguity as part of the protocol. One is, does this protocol impact transactions of sale, capital gains, which have crystallized already prior to the date of the protocol coming into force? That aspect of retrospectivity, there is confusion on. And definitely, I think it seems unintended and the government ought to clarify that it will impact only capital gains earned on or after the protocol is notified by both countries. There is a second aspect to the ambiguity here. And that is, as we all know, Mauritius Treaty was amended in 2016 with the result that any investments made after 31st March 2017, capital gains was taxable in India, unlike earlier where it was completely non-taxable in India. Now, when that 2016 amendment came, the government grandfathered all investments or acquisitions that had already been done up to 31st March 2017, and these were grandfathered, so to say. And irrespective of when in future these acquisitions were sold, the capital gain exemption under the treaty, non-taxability in India was almost certainly guaranteed. So investments made before March 17, exits at any time in the future were grandfathered, so to say. Non-taxability in India was a given. This protocol, the second ambiguity that it creates is, Will this grandfathering be respected after this protocol, or will the grandfathering also be subject to the Mauritius company fulfilling the principal purpose test? That again is a second controversy, and that again needs to be very clearly clarified by the government. Both are ambiguous from the language of the protocol. The first one, that the protocol applies only for sales exits after the date of protocol coming into effect, I think was the intention to make it effective only prospectively. And therefore, the government should not find it difficult to clarify that. Whether the grandfathered investments, irrespective of when they are transferred, even after the protocol becomes effective, would still enjoy the benefit of grandfathering, that again is not clear from the particular language of the protocol. That I'm not too sure what is the intent of the government, but I would really wish that they respect the grandfathering that was guaranteed in 2016, and therefore shares acquired before March 17 should continue to get the benefit of the treaty without having to go into the principal purpose test fulfillment condition, even after the protocol comes into existence, even if the shares are sold maybe 2 years after today.
Yeah, because the amounts are probably large. I mean, some data that we have show that the total assets under custody at the end of FY17, these are FPI assets, debt and equity put together. That's FDI. Let's move to the FPI table as well. The FPI assets were about 4.65 lakh crores, and as of FY23, that number has come down. These are Mauritius assets I'm talking about, but it's still, fairly significant at 4.18 lakh crores. The total FPI assets under custody, debt and equity, capital markets put together, money coming in from Singapore. This is capital gains, Pranav. Just before we wind up, I want your take also on dividend taxation, because from what I understand, that under the treaty, investors enjoy a more favorable tax regime for dividends, which are paid out by Indian companies. So what happens? For instance, for once, if we just assume that this is not retrospective, it is only prospective, then what happens to both capital gains and the way dividends are getting taxed today for foreign investors?
So dividends, if assuming the protocol is only prospective in effect, dividends that are earned, dividends that are distributed after the protocol comes into effect will be subject to, the treaty benefit will be subject to principal purpose test being met, meaning the Mauritius company will have to demonstrate that the main purpose, one of the main purposes was not just to take tax advantage. One of the main purposes for investing in India through Mauritius was not to take only a tax advantage. Having said that, how dividend works, normally, if the shareholder was a major shareholder, maybe a MNC holding significant stake in India, more than 10%, the dividend will be taxable in India at only 5% in the hands of the overseas shareholder if the shareholder is a Mauritius entity. But for most other public market participants, especially shareholders who hold not more than 10%, the tax rate under the treaty for dividend income from an Indian company is capped at 15%. So instead of 5, it becomes 15%. It's still much lesser than how dividend gets taxed under the domestic tax law, which for foreign shareholders would normally bear tax at 20%. Of course, Indian shareholders would probably pay more, but foreign shareholders under domestic tax law would pay 20%. So in order to get the concessional 15% or 5%, as the case may be, one would now have to show that the one of the principal purposes of investing into India through Mauritius was not to mitigate Indian taxes. That onus will be there to demonstrate that for dividends earned after the protocol becomes effective.
Got it. All right. So investors will have to now prove to the tax department that they are not coming via Mauritius only to avoid paying Indian taxes. Got it, Pranav. Thank you very much. With that, we're completely out of time on this edition of Trading Hour. Do stay tuned. Halftime report is up next.